In our very first podcast about saving and investing, we have already learnt that people invest in order to achieve a certain return. When choosing their investments, many investors primarily focus on interest rate levels, growth perspectives of companies they buy shares from, past performances of investment funds, or potential capital gains. Most often, they tend to neglect or at least to underestimate an element that has a huge impact on the success of their investment: the costs of investing. Managing a customer's savings or securities account, developing a financial product, buying securities at the stock exchange on behalf of the customer, managing an investment fund, offering investment advice are all financial services, and those who provide them want to get paid for these services. However, providers of financial services rarely send clients detailed invoices regarding their services. Instead, they charge their customers fees and commissions. The problem is that firms are often very discreet about the cost of their services and various offerings. This makes that some fees and commissions are clearly indicated, while others are not. Some are one-off fees, others are recurring, some are fixed, others are variable. The financial industry sells performance and does not talk much about cost, but both go hand in hand. Good investment performance is eroded by high costs. After all, what you earn from your investments at the end is performance minus cost. Investment success therefore begins with keeping costs as low as possible. To be able to do so, be aware that dispatched and hidden, direct and indirect costs that might be linked to your investment can be extremely diverse. So ask as many questions as you can to find out which costs apply to your specific investment, and ask these questions before you invest. This will allow you to look for alternatives that provide the same return at lower costs. The first type of costs you have to identify are the costs that occur at the time of the investment. When you invest on the stock market, buying equities or bonds, for example, you will have to bear transaction and brokerage fees. When you invest in an investment fund, you are normally charged a subscription fee, the importance of which depends on the type of fund you invest in. A direct investment in real estate normally goes with relatively substantial registration duties, lawyers, and notarial fees. And when you subscribe to a life insurance contract, the first premiums you will pay will very likely be used to pay the agent who sold you the insurance contract. The price you pay for the item you invest in, be it equities, bonds, art, antiques, wine, vintage cars, or real estate, and the transaction costs that go along with your investment are far from being the end of the story. Once your investment's made, you will have to deal with the costs of holding the investment. Depending on the item you invest in, you have to bear maintenance costs, storage costs, or insurance costs. Your bank will charge you a recurring fee for safekeeping your securities on securities accounts. Even a simple savings account at your bank will generate account management fees. An investment fund may charge you a management fee for running the fund, or a fee to cover the cost for safeguarding the units of the fund in a custody account. Further to this, every transaction made by the fund itself will generate brokerage commissions. Be aware, the longer the term of your investment, the higher the impact of recurring fees and commissions. Last but not least, costs may occur when you disinvest, or in other words, when you intend to recover the money you invested. When selling the items you have invested in, bear in mind that costs and fees might apply. When you sell your securities, you will have to bear transaction and brokerage fees, exactly as you did when purchasing the securities. Investment funds may charge you an exit fee when you leave the fund. And finally, whatever investment you make, taxes and duties can have a negative impact on the return of your investment. These few examples are very far from covering all the costs that may occur when you invest. Sound financial products have a price, and good financial advice deserves adequate remuneration. So don't choose an investment just because it costs less, but make sure you're not paying too much either. Carefully investigate fees, commissions, charges, and duties, and keep in mind that low transparency of a financial product can often be associated with high costs. Should the variety of potential costs discourage you from investing, remember that not investing will cost you money as well. By simply putting your money under the mattress, inflation makes that the value of your money is shrinking over time.